Well, thanks for joining us on this LRP insurance presentation. I'm going to just take you guys through this really quick so that you get a grasp of how this works. I think this is something that anybody with cattle should look at now that we're in such an inflated futures market. It's been available for several years. They made improvements to this program that make it more desirable. Plus, we are at what appears to be a pretty good peak in this cattle market. So now would be a time to look at doing this. You can price out calves that are still in the cows. So if you preg check your cows, you know you roughly are going to have so many calves to sell next summer or fall. We can price those out now and leave all the upside for you too. So LRP stands for Livestock Risk Protection. It's basically a subsidized put option. Any of you that have done puts and calls in like wheat or barley, you understand that's basically insurance that you buy. And once the futures market gets below a certain strike price, it starts to pay you back, right? But it leaves your upside part of it, which is the real appealing part here, because there's certainly a chance the cattle market could run up again. That seems to be where the news is all headed, but there is always a chance you could have a mad cow event or something and lose this great opportunity too. So the other advantage of this is subsidized. The government pays for part of it, of your put. You can do any number of head from 1 to 25,000. Or on a put option, you're stuck with 50,000 pound contracts. So we can do 10 head of cattle if that's all you guys have that you want to market on this thing. You don't have to price them all at once. If you want to stagger this out, we can do that. And it provides downside coverage with unlimited upside. So it leaves you with the upside in this cattle market, which it looks like there hopefully is some, but it would protect where we're at right now. So how it works, there's quotes every day. After the market closes on this insurance, they're basically the cost of a put option subsidized is what we would see. So the closer we get to the cattle market actual price, the more expensive it's going to be. You pick the time frame you want to market the cattle. I'll take you through that in some following slides here. You choose a percentage of that price you want to insure. The closer we get to the actual futures market price, the more it's going to cost, of course. And then the premiums due the first of the month after the coverage ends. So here's just a few of the rules that are important to understand before you get into this. You can't sell then those cattle that we're insuring more than 60 days prior to the end of the coverage period. So let's say that you had told us I was going to market my calves in October, but then we get to June and it's really dry and you want to sell the cows and calves off at that point. If that was more than 60 days prior to October, which that would be, right, you would still have to pay the premium on this. But would have no coverage because you wouldn't have the animals to prove in the end that you own them within 60 days at the end of the period. So you can roll that coverage to somebody else. So if you ended up in a weird scenario like that where you had to sell your cows and calves off, we could transfer that coverage to whoever bought them as long as they meet some criteria, which we can go through with you. So you don't have to sell the cattle by the end date. So if you decided you wanted to pick your price point in July, and then we get to September, let's say, and you decided, oh, I want to keep all these cattle over as yearlings, that is fine. The insurance would pay in July if there was a payable loss at that point, and you can retain ownership of the cattle longer if you want to. We just can't sell them prior to 60 days, 60 days from when that strike price is set. So you need to report deceased cattle to us within 72 hours of a loss if those are cattle that we're insuring on this. If you lose a couple of calves, let's say you insure your steers and heifers, as you're going to see going forward here, and you gave us the exact number of those, and then you lose a couple. If you tell us within 72 hours, then those cattle actually would carry on till the end as insurable and would have payable losses on them. If you don't tell us about it, and then we get to the end and you're short the cattle, you pay premium on that, but you wouldn't have enough cattle to cover the number you told us, and you wouldn't be paid on those head that were short, basically. So onborn calves, this is really appealing right now, I think, because the market is so high, it gives us a chance to lock in these calves while they're still in the cows even. So you can price calves that aren't born yet. You pick a coverage date when you think the calves will be less than 600 pounds. That this endorsement will only let us insure calves up to 600 pounds roughly. And then a great way to lock in a high market for next year's calf crop. So let's say that you don't calve till March. So we're talking about right now, you've got cows that we've preg checked. We know we've got 100 cows here that are bred. We'd like to lock in this price for these calves coming next summer. But we don't have the calves on the ground yet. We can do that now with this endorsement, which is pretty cool. So We'll take you through an example of that at the end of this. The next class of cattle we can insure is feeder cattle. So these would be cattle that are born, that they're on the hoof there, right, or whatever. So, and we've got two weight classes. So these weight classes would be whatever we expect these cattle to be at the end of this endorsement period. So you can go from 0 to 600 pounds or 6 to 900 pounds. And then the 0 to 600 pound range, they get 10% over the current futures price for the steers, and then the heifers would be priced right at the current futures market. So like if you're using August feeders, you'd have that price as your base for what we're going to use for this insurance. For the steer end of it, you'd get 10% over. For the 6 to 900 pound or the heavier calves, this would maybe be if you keep over yearlings too. You get the straight futures price for the steers in that scenario, and then they'd price the heifers back at 90% of whatever that value is. So that's why they make us report steers versus heifers. They're going to price the heifers back in value, which is how it would work in reality anyways, right? So fed cattle, this would be used more for cattle put into a feedlot or finishing out. If you retain ownership on cattle, you could use this then to lock that price in too. That's 1,000 to 1,600 pound weight ranges, and it uses the fed cattle futures instead of the feeders. I'm not going to spend a lot of time on this because a lot of you guys probably aren't doing anything with fed cattle, but if you want to, get a hold of us and we'd be glad to explain this some more. So here's just a quick example of how this would work. We've got 100 head of bred cows. It's January 1st, so pretty close to this time frame if you're just watching this video, and would like to lock in a bottom on your calf price using LRP. So if we've got cows we preg checked, we know we've got 100 bred cows there. Let's say that you normally sell those calves on October 15th at around 600 pounds. So that's going to fit this program really well. And then we have a 5% depth loss usually during calving, and so we're only going to price 95 head of calves. Even though we've got 100 bred cows, we only are going to have 95 calves probably that we're going to be able to sell in October, right? So you want to be realistic about what you're going to have for calf numbers. That if we keep that number about where it normally would be, then we don't have to do a lot of that death loss reporting and stuff for this program. So October 15th is 42 weeks out from our current date, which would be January 1st in this scenario. So we're going to price our onborn calves 42 weeks out. If you normally would video sale those calves in July, I wouldn't be looking at October 15th. I'd be looking at July, right? The date you're going to have these priced somewhere else other than the insurance. So in this scenario, we're going to look at somewhere close to 42 weeks out, or that date that we're normally going to sell it. So on this next slide, I'm going to show you we're going to pick the 39-week out time period. So here, like we talked about in this example, we have a whole bunch of options that we can pick here on the feeder cattle futures market. So if you look at this expected ending value, that would be where the futures market actually closed at basically for that day. So we've got a 265 here for what probably we're out into September. So these are probably October feeders would be the market that we're using here. But anyways, that market closed at 265. And then the coverage price would be whatever percentage of that price that put gets placed at. So in this example, if you look at my pointer here, this is 93% of the current futures market price. The cost would have been $11.80 per hundredweight, but because the government's paying part of your premium, you're only paying $7 a hundredweight in this scenario. So in my example here, I picked this level. I could get closer to the futures market. If you look up here, we're at the 39 weeks out thing. I could get to the 260 price, which is where it would start paying at the 98% coverage level, but it's going to cost me $11 per hundredweight in that scenario. Where if I go down here to a little bit more reasonable level, this gets me down to $7 a hundred. Let's say that's what I'm comfortable with. So that's what I'm going to use here for the insurance. So the farther we get out, so we're quite a ways out, right, from when the insurance endorsement is done here. We're 39 weeks out. The farther we get out, the more expensive this is going to be because there's more risk. If we got back to closer to 20 weeks out, if that's when you want to price some of these cattle, it's going to be a lot cheaper here. So in this example, anyways, we're at $7 per 100 pounds. So on a 600 pound calf, we'd be at 7 times 6 or $40 roughly a head. And that's going to protect us if the futures market drops below 247 when we hit this 39 weeks out from now time frame, which I think is a very real possibility that something could happen as far as a major correction in here. So we chose the coverage level at 93%, like we looked at on that previous quote slide. That cost us $7 a hundred, or 7 cents a pound that we're giving up to be protected at $2.47 a pound, or $2.47 per hundredweight. So we've got 95 head at 600 pounds. That's 57,000 pounds of calves that we're insuring here in this example at 7 cents a pound premium. So it's going to cost us $3,990 to do this insurance. This is for 39 weeks out, which puts our end date for this endorsement at 9/25 or September 25th. So pretty close to when we're going to sell these cattle, right? So on September 25th, whatever happened with that futures market at that point, that's what's going to trigger this loss payment. So this next slide will show us the cattle market resets back to $1.75 per hundred, which is totally reasonable that this could happen. That wasn't even probably a year and a half ago we were at that level, right? So let's say the cattle market, something happens. There's a big recession here and the people can't afford to buy beef, or we hit a mad cow situation and the cattle market resets back to $1.75 a hundredweight, which would still be a pretty good cattle market. Our coverage price, remember, that we picked, that guaranteed us $2.47 a pound. So we take the $2.47 a hundredweight, $247 a hundredweight minus the $175 a hundredweight, and we had a $72 per hundredweight loss, or a 72 cent a pound loss that's payable to us now. We have 95 head still. Those cattle made it, or whatever. We calved. We got 95 head of calves times 600 pounds, which is 57,000 pounds. The 57,000 pounds times the 72 cents a pound means we get a $41,000 loss payment for $3,900 in premium. So that's just one example of how, if this market came uncorked and we kind of missed out on the top end of this, this is a good way to lock that in. Now, let's say that the cattle market didn't do this and it went from that 247 that we set our strike price up back up to $3 where we almost were at. In that scenario, you'd pay this $3,900 premium, but you would have gotten so much more for your calves that would more than offset this premium payment, right? So there's one example of a loss and how that would work on onborn calves that we had priced. There's some loss rules. You must submit a loss within 60 days at the end of coverage. That shouldn't be a problem because most of you will want that money at that point to think if the cattle market tanked. I know, just like crop insurance, you have to tell us if there's a loss. We'll also run some reports that'll show if there's loss triggers on our end here too. And then you may have to prove the number of head of cattle that you had, usually with sale receipts or vet records if you kept the cattle. So just be prepared to kind of prove up that you actually had the cattle, or you still have the cattle that we priced out. And why look at this now? So this is a picture of the feeder cattle futures market from 2020 up till about 2024 now. You can see we were idling here at around $1.50, 100 for years, basically, right? We started getting a pretty decent run up here in 22. That got us up to about the $1.75, which in my example is where my loss was paid out at. But we have had such a ridiculous run in the cattle market. We hit 275 and we lost a fair amount of that. It seems that we're at the bottom of that correction and it's starting back up. Let's hope. But there is room for this to fall back off, right? And that's why we'd want to look at pricing these calves, a bottom on these calves now. We're in a market where we can make some money. We can lock that in. We're going to give up a little bit of our profit. Like in that last scenario, we gave up $40 a head, but that's locking in a $2.50, almost a pound price on 600 pound calves. So in that scenario, we're looking at $1,500 calves potentially, and it's going to cost us about $30 or $40 a head to lock that in. So in my mind, that's a pretty good trade-off. It would be even less money if we looked at closer pricing. So if you were looking at video sailing your calves in July in that last example, instead of being $7 a hundred, it might only be $4 a hundred for that insurance coverage there. So how to get started? The first thing we need to do with any of you guys is to get a policy set up, and that just sets a baseline so that we can do endorsements upon this policy. So we can set a policy up. If you never use it, it's not going to cost you anything, but that means you call our office, we get you enrolled in this program. You don't commit to any insurance or any premium until you tell us you want to put some cattle on there. And then once you decide to price the cattle, we need to know between 3 p.m. and 5 p.m. that day and get you in an e-sign and app. So if we can get you to do all of those things, which is pretty simple, you'll have coverage on those cattle. If the market tanks, at least we'll lock in this high price. If you have more interest in this, please just get a hold of me. And I just wanted to make sure we got this out to you guys, as I think this is a pretty unusual time in the cattle market here. So, like I said, give us a call. We'd be glad to get you set up on this, and I will pass this video on to you here real quickly.